Welcome to Chapter 7, Non-Bank Operations. So far we've looked at commercial banks. Today we turn to financial institutions that are not traditional banks, but still play a huge role in the financial system. Insurance companies, pension funds, finance companies, mutual funds, and securities firms. Understanding how they work helps us see how savings get mobilized and channeled into productive investment, even outside the banking system. By the end of this chapter, you should be able to do 5 things. Understand why non-bank financial institutions matter, and how they differ from banks. Identify the key types: insurance companies, pension funds, finance companies, mutual funds, thrift institutions, and securities firms. Examine how the major players, especially insurance companies and pension funds, actually operate and invest. Explore the specific roles of finance companies and mutual funds. And finally, assess how all these institutions, together, contribute to economic growth. This chapter covers 5 groups of institutions: finance companies, insurance companies, pension funds, mutual funds, and a few other non-bank operations, mainly securities firms. We'll go through each one and look at how it raises funds and how it uses those funds. The same framework we used for commercial banks in the last chapter. Our main references for this chapter come from Madura's textbook, chapters 21 through 25, and from Mishkin and Aikens, Financial Markets and Institutions. From Mishkin, we'll draw mainly on the chapters covering mutual funds, insurance companies and pension funds, and investment banks and securities firms. These give us a good conceptual foundation, even though the exact numbers you'll see there are a bit dated. The concepts themselves still apply directly to how these institutions work today. Let's start with Section 7.1, an overview of non-bank operations. So what exactly makes an institution non-bank? Like banks, non-bank financial institutions are still financial intermediaries. They raise capital by issuing financial instruments, and they invest that capital in other financial instruments. The difference is simply that they are not commercial banks. They don't take checking deposits and make ordinary loans the way a bank does. This chapter groups them into 2 broad categories: contractual savings institutions, think insurance companies and pension funds, and investment intermediaries, think mutual funds and finance companies. We'll go through each group in turn. Section 7.2, Contractual Saving Institutions. Contractual savings institutions raise funds by collecting regular premium payments from policyholders, and then they make payments to policyholders or beneficiaries when a specific, contractually defined event happens, because there's a mismatch, in both timing and amount, between when premiums come in and when claims go out. These institutions build up large pools of accumulated funds, and since they know fairly well, on average, how much they'll need to pay out and when, they can invest a large share of these funds in longer-term financial assets, like bonds and mortgages, rather than keeping everything liquid the way a bank has to. Contractual savings institutions fall into 2 groups: insurance companies, which split further into life insurance companies and property and casualty insurance companies, and pension funds. Let's look at insurance companies first. Insurance companies exist to provide insurance and retirement funding to individuals, firms, and government agencies. As Mishkin puts it, an insurance company is really in the business of assuming risk on behalf of its customers, in exchange for a fee. The premium. Why do people pay premiums? Even though on average, over the life of the policy, they'll pay more than they ever collect back? Because most people are risk-averse. They'd rather pay a known, certain amount than face the small chance of a very large loss. To price that risk properly, insurance companies employ underwriters, whose job is to assess how risky a specific policy actually is. Several factors determine the premium you pay. First, the probability that the company will have to pay out, and how large that potential payout could be. Second, how competitive the market is for that type of insurance. More competition pushes premiums down. Third, the present value of the expected payment. Future payouts are discounted back to today's dollars. And finally, the premium includes a markup on top of all that, to cover the company's overhead and to leave room for profit. Here's the tricky part. If insurers just use statistics about the general population, they run into two classic problems. The same two problems Mishkin describes as central to financial markets generally. Adverse selection. People who already know they're higher risk are more likely to seek out insurance in the first place. So the pool of people who actually buy the policy is riskier than the general population. And moral hazard. Once people are insured, some of them take more risks than they would have otherwise. Precisely because they know they're covered. Because of this, insurers can't just rely on population-wide statistics. They need to estimate the probability of loss specifically among the people who actually choose to buy insurance, not the average person on the street. Between collecting premiums and paying out claims, insurance companies invest the funds they're holding, so their overall financial performance depends partly on how well those investments perform. Every investment decision has to balance three goals at once: return, liquidity, and risk. They want a high return, but not at the cost of taking on too much risk. And they always need to keep enough liquidity on hand so they can pay claims when they actually come due. Which, remember, can be somewhat unpredictable in timing. This exhibit shows the bigger picture. How insurance companies channel funds from your premium payments into the real economy. They use the funds to buy corporate stocks and bonds. Financing business investment. They buy treasury and municipal bonds. Financing government spending. And they use part of their funds to purchase household and commercial real estate. So in a very real sense, every time you pay an insurance premium, some of that money ends up financing a company's expansion, a government project, or a piece of real estate. Life insurance is the dominant force within the insurance industry. The basic idea is simple. The company pays out to the beneficiary when the policyholder dies. The premium is set to reflect the probability that a payment will need to be made, and the expected size and timing of that payment. One increasingly popular product is group life insurance, offered through an employer to all its employees. This has become a major source of business for life insurers in recent years. Where do life insurers get their money? Premiums are the largest identifiable slice, about 31% of total income. But the single most important source is actually annuity plans. Think of these as the reverse of insurance, where the customer pays in and later receives a stream of payments back. The third largest source is investment income, the returns earned on their existing investment portfolio. On top of this, insurers build up capital through retained earnings and by issuing new stock. And they use that capital to finance fixed assets. Holding adequate capital does two things. It cushions the company against unexpected losses. And it reassures customers that the company will actually be there to pay out when needed. Now, what do life insurers do with all this money? First, government securities, treasury bonds, state and local government bonds, and even foreign bonds. Second, corporate securities. Corporate bonds are actually the single most popular asset for life insurers. Usually a mix of medium and long-term maturities, chosen to help manage cash flow and liquidity needs. They also invest in packaged bundles of corporate loans, known as collateralized loan obligations, or CLO. Beyond bonds, life insurers also hold mortgages of every type: 1 to 4 family homes, multifamily housing, commercial property, even farm mortgages. Usually these are originated by another financial institution first, then sold to the insurer on the secondary market. So the insurer is really just acting as the ultimate creditor. Some insurers go a step further and purchase real estate directly, then lease it out commercially, aiming for a higher return than they'd get simply holding a mortgage. And finally, life insurers make policy loans, lending a small portion of their funds directly to whole life policyholders, usually against the cash value that's built up in their own policy. Now let's turn to property and casualty insurance. A very different animal from life insurance. It protects against things like fire, theft, and liability claims, which cause economic, and sometimes non-economic, damage. Property insurance covers physical things, buildings, cars, other assets. Casualty insurance covers liability, the risk that you might cause harm to someone else, say through a product failure or an accident. Just like with life insurance, the premium reflects both the probability and the potential size of a payout. But structurally, property and casualty insurance behaves quite differently from life insurance. Claims are far less predictable in timing and size. Health insurance covers a range of medical costs, hospital stays, doctor visits, surgical procedures, and so on. Business insurance protects companies against a wide variety of risks, and some of it actually overlaps with property and casualty coverage. One important type is liability insurance, which protects a business against claims brought by its own employees. For example, workplace injury claims. Bond insurance protects investors who buy bonds, in case the issuer defaults. But here's the catch. This protection is only as strong as the insurance company's own ability to pay claims. During the 2008 credit crisis, this became a very real problem. Many bonds that were supposedly insured still suffered major losses, because the insurers themselves ran into financial trouble and couldn't cover all the claims coming in at once. Mortgage insurance protects the lender, not the borrower, in case a homeowner defaults on their mortgage payments. Because of this risk, mortgage lenders commonly require homeowners to carry this insurance, especially when the down payment is small. The homeowner pays for it through periodic premiums, even though the insurance is really there to protect the bank. Now let's turn to pension funds. A pension fund is essentially a structured savings plan that helps employees build up retirement income. It's funded by contributions from the employer, the employee, or both. And because pension funds accumulate very large pools of long-term money, they become major institutional investors, putting significant capital into stocks, bonds, and various loan-based instruments, including mortgage-backed securities. Pension funds split into two broad categories. Public pension funds are run at the state, local, or federal level, and many operate on a pay-as-you-go basis, meaning today's contributions from current workers are actually funding today's retirees, rather than being invested and saved specifically for those same workers. Private pension plans are set up by private organizations, companies, unions, nonprofits, educational institutions. Within private plans, there are two structures. A defined benefit plan promises a specific payout at retirement, calculated with a formula, usually based on years worked and final salary. And it's the employer's job to make sure enough funds are set aside to cover that promise. A defined contribution plan, by contrast, only specifies what goes in. The eventual payout depends entirely on how well the fund's investments perform over time. This shifts the investment risk from the employer onto the employee, which is one reason defined contribution plans have become so much more common in recent years. Just like with insurance companies, this exhibit shows how pension funds channel workers' retirement savings into productive investment. Stocks, bonds, mortgage-backed securities, funding businesses, governments, and households, and in doing so, helping fuel broader economic growth. Section 7.3. Investment intermediaries. This covers finance companies, mutual funds, and securities firms. Finance companies specialize in short and intermediate-term credit for consumers and small businesses. There are three main types: consumer finance companies, which lend directly to individuals; business finance companies, which lend to small and medium-sized businesses; and captive finance subsidiaries, companies owned by a parent manufacturer specifically to finance the sale of that parent's own products. Think of an automaker's financing arm helping customers buy its cars. Let's go a bit deeper on each type. Consumer finance companies finance purchases made at retail stores or from wholesalers. And many also offer personal loans and mortgages directly. Business finance companies lend to small businesses and also issue business credit cards. And a captive finance subsidiary is wholly owned by its parent company. Its job is to finance sales of the parent's products, provide wholesale financing to the parent's dealers or distributors, and purchase the parent company's receivables. Where do finance companies get their money? Unlike banks, they can't take deposits in most cases, so they rely on other channels. They borrow from commercial banks, often renewing these loans regularly. They issue commercial paper. Mishkin describes this as unsecured short-term debt that large, well-known companies can place directly with investors, while smaller finance companies typically go through a dealer. In a few states, they're allowed to accept limited customer deposits, though this isn't a major source. For long-term funding, they can issue bonds. The decision depends on their balance sheet and where they expect interest rates to head. And finally, like any company, they build capital through retained earnings or by issuing stock. On the asset side, finance companies put their funds to three main uses: consumer loans, personal loans, auto loans, home improvement loans, financing for mobile homes, and so on, business loans and leasing, extending commercial credit and leasing equipment to businesses, and real estate loans, commercial mortgages and second mortgages on residential property. Exactly how a finance company splits its funds across these three categories depends on whether it's mainly focused on serving consumers or businesses. This exhibit highlights the role finance companies play in the broader economy. By extending credit to consumers and small businesses that might not always qualify for a traditional bank loan, they help fund consumption and business activity that supports overall economic growth. A mutual fund is an investment company that sells shares to investors and uses the money raised to build and manage a portfolio of securities. Mishkin highlights a few key reasons mutual funds have grown so large. First, denomination intermediation. Pooling many small investors' money lets the fund buy securities, like large denomination money market instruments, that an individual investor could never afford alone. Second, diversification. Spreading risk across many securities is much easier with a large pooled fund than it is for someone investing on their own. Third, cost advantages. Institutional-sized trades get much lower transaction fees than small individual trades do. And fourth, access to professional management. Even though research shows the average fund doesn't consistently beat the market, many investors still value having a professional manager pick their portfolio for them. This exhibit shows mutual funds playing the same intermediary role we've seen elsewhere, pooling small investors' savings and channeling that capital toward corporations and governments that need financing, both in the primary market when securities are first issued, and in the secondary market afterward. Mutual funds can be structured two ways. Based on share liquidity, open-end funds let investors buy in or redeem their shares at any time, so the number of shares outstanding is constantly changing. Because the fund is always ready to buy back shares, this gives investors a lot of liquidity, which is a big part of why open-end funds dominate the market today. Roughly 98% of all mutual fund money sits in open-end funds. Closed-end funds work differently. A fixed number of shares is sold once, at launch, and after that the fund doesn't redeem shares directly. Instead, those shares trade on an exchange like a stock, which means the market price can actually drift away from the true value of the fund's underlying assets, trading at a premium or a discount. Mutual funds are also categorized by what they invest in. Stock mutual funds focus on equities. Bond mutual funds focus on fixed income securities. Money market mutual funds hold short-term, low-risk instruments. And exchange-traded funds, or ETFs, trade throughout the day like a stock, while still offering the diversification benefits of a traditional fund. Beyond these mainstream categories, there are more specialized vehicles: venture capital funds, private equity funds, vulture funds that target distressed assets, hedge funds, and real estate investment trusts, or REITs, each built around a particular strategy and risk profile. Now let's shift to securities firms, what Mishkin calls investment banks. Despite the name, an investment bank isn't really a bank in the traditional sense. It doesn't take deposits and make loans. Instead, it's an intermediary that helps corporations raise funds by issuing securities. The process has 3 stages. Origination. The firm advises the corporation on how much stock to issue and at what price. And pricing is genuinely tricky, because the issuing company wants the highest price possible, while the underwriter doesn't want to overprice the stock and get stuck unable to resell it. Underwriting. The lead firm often forms a syndicate, bringing in other securities firms to each take on a portion of the issue and share the risk. This matters especially for large IPOs. In distribution. Once all the agreements are signed and the SEC approves the registration, the shares finally go on sale. 2 more services round out the stock offering process. Advising. The securities firm doesn't just disappear after the origination stage. It often continues advising the company on the timing, amount, and terms of future financing, well after the stock is issued. And private placement. Instead of selling to the general public, sometimes the entire stock offering is placed directly with a small group of institutional investors. This route skips a lot of the public disclosure requirements, so it's often faster and cheaper, though it limits how widely the shares are held. The process for issuing bonds follows the exact same 5 steps as for stock. Origination, underwriting, distribution, advising, and private placement. The details differ a bit. For bond issues, the investment bank also has to arrange a credit rating from an agency like Standard & Poor's or Moody's, and hire a trustee to make sure the issuer meets its obligations under the bond contract. But the overall structure of the process is the same one we just walked through for equity. Securities firms also play a key role in leveraged buyouts, or LBOs. First, they assess the market value of the target company or division, to make sure the acquirer doesn't overpay. Second, they arrange the financing. Remember, an LBO relies heavily on debt. Third, they help the acquirer actually purchase the outstanding common stock of the target firm. And often, they stay on afterward in an advisory role, helping manage the transaction through to completion. Securities firms also facilitate arbitrage, buying undervalued shares with the goal of reselling them later at a higher price. They work closely with arbitrage firms, helping identify undervalued companies and arranging financing for the trade. It's sometimes genuinely hard to draw a clean line between arbitrage and an LBO, since both can involve buying up a company's shares, and not every arbitrage attempt succeeds. Sometimes the target company manages to fend off the takeover attempt entirely. Securities firms also advise on corporate restructuring more broadly, evaluating how a merger, a separation of 2 businesses, or a spin-off, where a new set of shares is created and distributed to existing shareholders, might change a company's overall valuation. And beyond advice, they help raise the actual capital needed to finance mergers and acquisitions, tapping the capital markets on the client's behalf. Finally, 2 more core activities. Brokerage services. Securities firms execute buy and sell orders for their clients, and they're generally split into full-service firms, which offer research and advice alongside execution, and discount brokers, which just execute trades. And online trading platforms have driven the cost of placing an order down dramatically. And second, securities firms also invest their own capital, putting their own money into stocks, bonds, mortgage-backed securities, and derivatives, on top of everything they do for clients. So let's bring this together. Non-bank financial institutions, insurance companies, pension funds, finance companies, mutual funds, and securities firms all do what banks do at a basic level. They raise funds and put those funds to work, but each one plays a distinct role. Insurance companies and pension funds pool contractual savings and invest for the long term. Finance companies extend credit, banks might not. Mutual funds give ordinary investors access to diversification and professional management. And securities firms help corporations and governments raise capital directly in the markets. Together, they make our financial system far more complete than banks alone could ever be. That's the end of Chapter 7.